welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for Market Insights and Observations. Today is August 8th of 2023. Let's get right down to the three things we're watching you should be paying attention to as markets are moving. So thanks for watching. So right out of the gate, we're going to talk about the markets. We're also going to talk about the corrective phase that's ongoing within the markets, not just the equity market, but specifically in the U.S. Treasury market. That's to be noted. And we're going to continue to talk about the Treasury Outlook. Markets have been moving, and basically, here's the bottom line. The market itself is continued near historic levels on the equity level in terms of higher highs, which is confounding most year to date, including me. But we're positioned accordingly, so we're well in the realm of taking advantage of it. But we're also balanced and diversified, as I've always talked about, as well as keeping some dry powder for when we enter corrective phases, both on the equity and the fixed income market. But let's talk about the market itself in terms of the M2 money supply and the Fed balance sheet. It continues to shrink at an aggressive pace, and the money supply is also shrinking to historic levels. That is taking oxygen out of the economy. So the slowing down of the economy is working by way of the Fed. Let's look at valuations for the equity market. You know, one of the things we do when we look at sort of the pricing, the fair value of when to add more capital or deploy in terms of rebalancing from a strategic rebalancing standpoint into equities or even fixed income are valuations. And historically, long-term valuations are around a 17 times on an average for the S&P 500. Right now, we're at about a 19.9 of the next 12 months moving forward earnings. So what has to happen for the equity prices, if you will, or stock prices to go higher? That means that companies have to earn more, so the price to earnings ratio, that ratio basically comes down, meaning that the top line revenue is growing. And so right now we're not seeing that at this moment in time. We're talking about corporate margins. They haven't dropped as dramatically as some have predicted, but they've dropped some nevertheless. And that's sort of why the market itself is sort of taking a sigh of relief and sort of a breath of fresh air at the same time, because the second quarter earnings that have been reported right now, we're seeing about 84% have reported of the S&P 500, of which 79% have met above the expectations or even the guidance that they projected. Now, how does that look historically speaking? Well, 79% that have met and exceeded expectations. The 5-year and the 10-year average is about 75, 77 respectively in terms of those really that report and beat. So we're above that, meaning companies are doing better and margins on the most part are hanging in there, which means that also projects into a soft landing for the sort of the Fed's playbook, if you will, simply because corporations can hang in there. They're not shedding off or laying off as much as need be because margins are still in there, i.e. supporting growth. Even right now, growth of the second quarter for earnings. And it's also projected the third quarter and the fourth quarter growth of 0.2%. We'll see if that hangs in there for the third quarter of earnings for corporate America. And then 7.6% growth of earnings in the fourth quarter. So there's an acceleration of growth, at least projected, sort of the back half of towards year end, if you will. So we got to take a look at that. But what's really moving markets right now are the U.S. Treasury market, the debt downgrade by Finch. Moody's went after the banks this last 24 hours. And if we look at the U.S. Treasury market, let's just continue. We also labor market, just to finish this point here. Labor market ultimately is the ultimate lagging indicator. So when we look at labor markets as like, oh, how the economy is like sort of projected to do, it's always like, hey, corporations are laying off more and more and more to preserve the bottom lines. And that's sort of the dirty little secret of owning companies, because you see AI, which is efficiencies, technology efficiencies, mergers and acquisitions, if we hit a recession, will accelerate, meaning 2 + 2 = 3 or 4 or 5, but they'll get rid of sort of the sort of overlap of employees to basically to manage through that. And so corporations aren't doing excess layoffs just yet. So that's still that tension in the labor market. That's what the Fed's watching. That's what we're watching. And that's sort of what the reports that we're getting from the quarterly earnings right now. So the third quarter started out slightly in a deeper contraction. And just a reminder, the third and fourth quarter basically bode well into bear market territory sometimes as we get into sort of the third quarter, if you will. So we got to keep our powder dry. The Fed basically doesn't meet. They've got a couple of data points like the CPI and the PPI later this week and a few more before they actually meet again. And so the question is, do they keep interest rates right where they are? Well, if we look at interest rates themselves by way of the U.S. Treasury market, if you will, not what the Fed does, but what the Treasury market is actually telling us now, Outlook, a few things happened this week. So we're seeing a lot of volatility in the Treasury market, which is really setting the stage for ultimately, we believe, are even higher yields on the Treasury. So we've seen Treasury market get above the 409 level, which is a sort of a ceiling. We then believe it's trading down to about 401 right now as we speak, as we had a little sell-off. But some of the support there is the Bank of Japan tweaking their sort of their Bank of Japan their yield curve tightening, if you will. And what that's ultimately doing is raising the bar for us and putting a floor in our Treasury, 10-year Treasury, simply because there are no other alternatives, i.e. if the bank across the street is raising their interest rates, it's going to make us have to raise our interest rates to stay competitive for that same dollar that's circulating in the global economy. Now, keep in mind, also the Fitch downgrade. What that does is we go from lose our AAA status to AA plus. That also shrinks our market of available buyers, if you will, because some, not all, but there's institutions and pensions, foundations out there, and money management firms institutionally have a mandate that they can only have a certain percentage of AAA, or they have to have a certain percentage of AAA paper. Well, if U.S. debt is not AAA paper, you got to source elsewhere. Outside the U.S. sometimes for some sovereign debt that is AAA, but that's sort of the impact. So that what that means is if you shrink your buying pool because they can't have that in their portfolio, you're flooding the market and you're reducing the opportunity to have sort of the supply and demand meet. So what you have to do is that's raising the interest rates on the yield on the 10-year to become more attractive. In fact, just think of it this way, the debt downgrade. How does that mean? What does that actually mean? It just means that we're spending more or paying more for our debt. It's no different than you and I on a personal credit score basis, if you will. Let's say we go from the 800s to the 600s. Not that this is the case in that particular scenario, but just as an over-exaggerating example, if you have your credit score lowered, the next time you go for credit, let's say you're not in the tier 1, tier 2 top premium, which you ultimately get as a consumer the best rate. Let's say you drop down a couple of notches, you're going to get a higher rate on, let's say anything from mortgages to even cars. So you're paying more simply because you're theoretically a higher risk. That's what the downgrade means, and that's what we're doing right now. 14% of what we're paying right now on our GDP is our debt, and that's really historically the tipping point for maybe historically a recession has to ultimately hit the economy, and then treasuries will ultimately sell off. And in every sort of cycle that we've seen where there's a recession, we've seen the U.S. Treasury 10-year sell off around, on average, 225 basis points. Will we see that this time? Well, we have to hit the recession first and then Treasury. So what we're doing, how we're positioning, keeping our powder dry, high quality in equities. Equities are continuing just to sort of grind higher, if you will. There's always going to be volatility, which is pockets of opportunity for us, how we position and take advantage. We like energy here. One of the things that I didn't talk about right now is energy right now. Looks here again to stay energy sector. This sort of red diamond is indicating the percentage of stocks that are above their 50 and 200-day moving averages, which is a technical term meaning that sector specifically is very solid. And so when you get 100% of all the participants in that sector above their technical moving averages, it's one of the reasons why I was yesterday with Liz Clayman on Fox Business talking about why we like the energy sector is because it's a very bullish right now. So we believe it's a catch-up trade and an opportunity there. Again, we look at energy and we think energy prices are going higher. The energy sector is going higher. So we add that to the client portfolio. And then the basis points, we see the 10-year Treasury potentially hitting 5%. And that's basically what's going to happen before, let's say, a recession hits, and then it comes back by 225, maybe 200 basis points. So what we're doing is now we're extending all the maturities that we have in treasuries that are coming back to us, and we've done it right. I have to say, we position accordingly by basically doing 6 and 3, 6, and 12-month treasuries. All of those are maturing. We're extending those out. So we're going to be looking at extending that yield curve to lock in those higher rates. Ultimately, when rates sort of peak on the super cycle on the upside, setting higher highs, and then locking that in, and then ultimately, let's say if a recession hits, we can have at least that higher interest that we're getting while we wait. And so that's the projection and the update today of what the ultimately debt downgrade means for us. It just means higher ceiling and higher sort of base for the U.S. Treasury. Equities are hanging in there, and we're going to keep an eye on all the labor reports and the inflation data later this week. That's the key of what's going to be driving markets later this week. So that's a big update for today. Thanks for watching. Again, like, subscribe, share with friends and family, and we appreciate you paying attention and tuning in. Talk to you soon. Take care. Have a great day.